Guys, today we have on Austin Campbell, somebody who I've wanted to have on for a while, professor at NYU, which is exciting. And that's the first thing we're going to talk about. Yeah, maybe very brief intro, and then you could go right into what do you teach? Like, what do your courses look like? And yeah, what kind of bridge the gap for you between TradFi and crypto? And yeah, what do you do now?
Yeah, I mean the brief background for me is I really came from TradFi and started looking at all things blockchain much more from a market structure perspective. Like there are a lot of, I'm going to call it very libertarian people who come at this, a lot of people who come at it from monetary theory. And I'm the guy over in the corner, like, I just want to settle my trades. Right. And so it gives me a very different vector into the space. And it was a multi-year journey of helping to build like an early Bitcoin custodian, being the co-head of a digital assets group at a bank, helping to run one of the major stablecoins and build all of the reserves, risk, transparency, e.g. the how do we make this work and not lose everybody's money part. And combining that with a background of trading a lot of really gnarly, like fixed income stuff that, quite frankly, nobody wants to hear about on the internet. And they're making a good decision by not listening to me on that. So, that's kind of the mix. But all of this led me, I think, to a place of standing at the intersection of a couple of things, like as the car crash occurred. And as a result, for a while, what's bothered me about the space is really, call it information transfer and the discourse between people, which is part of why I got into teaching, where I've described this to my students. But one of the problems that you currently have in this space, and part of what we've started to address, and I'll explain how, is you have the blockchain and crypto people telling a story that's very important about core market technology, about open access, about trading, about settlement, about standards, right? And about who can use a system. And they're very important, both governance and structural questions in there. The finance world is kind of ignored because we duct taped this hairball together in the 1970s and it's kind of worked. So nobody's dealt with it since then. On the other hand, boy, are the crypto people terrible at risk management, right? Like there are a lot of things that come from traditional finance that, because people are reinventing the system, they just ignore it and move on, right? Great example. If anybody had worked on a repo desk, things like the Mango Markets hack just straight up would not have been able to happen, right? Because you wouldn't lend against like a spot price that had kicked up a massive amount in a couple of minutes. Okay, fine. So where did that leave me with teaching, to come back to your question? We were observing, this started at Columbia. Omid and I originally were looking at this, and now I teach at Stern with Ian D'Souza. And it's that the students didn't have a rigorous way to learn about this space, because when you go online, about 90% of the people are screaming and hysterical, and 45% of them are incredibly pro crypto and don't know what they're talking about. And another 45% are incredibly anti-crypto and also don't know what they are talking about. So if you're trying to like understand how things work, it's a disaster. And so we actually have two courses at Stern. There's the Blockchain 101, which is like, what's a blockchain? How does it work? What's Bitcoin? What's a consensus algorithm? How do you attack it? Like all the stuff you're used to. But kind of the next course, which is the one I teach with Ian, what I would call the equivalent of a financial markets survey course, but for crypto, which is to say, great, blockchains exist. Now what? Right. It is attempting to answer the who cares. So what's an AMM? What's a borrow lend protocol? What's a stablecoin? Bridges, oracles, hacks, security, all of the things that actually happen in this space. Like, why does Larry Fink care? Right? Why is there this huge fight about governance and decentralization? Why is Washington, D.C. currently on fire? And then importantly, how does this map to both markets transformation and just like sort of call it the history of financial innovation writ large, so that you can tell which of these things are likely to be useful in the long run and which of these things are, to be blunt, likely to be garbage.
Yeah. Okay. So you mentioned one thing right there, and we can just kind of start digging in. Washington on fire. I know that you've been very vocal and pro stablecoin really since so I think, correct me if I'm wrong here, if I'm putting words in your mouth, but I think that you believe that stablecoins are like one of the, effectively one of the 0 to 1 unlocks that crypto can provide. And as a result of that, you've been vocal, bullish, trying to educate the masses on how things actually work. I read a number of your tweets and threads, so I think I understand your position directionally. Talk to me about where we're at right now. I recently had on a lawyer, Zach Shapiro, who talked to me a bit about what was happening in Washington. But you've been very vocal about clarity and legislation around stables, and then maybe specifically this yield portion. Yeah, start rambling there, because I want to dig in. Again, I told you before I had some probing questions about this. So yeah, where are we at maybe with that?
I think it's a really misunderstood topic on both sides right now, and that's why the debate has been such a clown show. So I'm going to do the business school professor thing and start with some financial history, which is
Perfect.
After the great financial crisis in the United States, not the 2008 one, the 1929 one, there was an act in 1933 that was the Banking Reform Act, and it did three things. One, establish deposit insurance, because for anybody who lived through 2008, if you thought that was bad, I'm going to remind people that thousands of banks failed in a single year in 1933 that represented something like 1/3 of the entire U.S. banking system. And everybody was looking at this saying, it's over. The FDIC was created to stem that tide. But in return for the FDIC, the banks had to abide by some restrictions. And the big ones were one, Reg Q, which is a prohibition on the payment of yield on deposit products. So no interest on your checking account or savings account under Reg Q. The other one, which people have probably heard of, is Glass-Steagall, which is the separation of what you think of as banking if you're a normal two-legged human being, e.g. you go to the branch, you give them money, they have an account balance, you get checks, you get a credit card, like all that stuff, from investment banking, which is all the crazy stuff you read about in Liar's Poker, if you've read that book by Michael Lewis, of trading and sales and stock issuance and all the stuff I used to do. Okay. Now, we fast forward from there to a 60-year period of bankers arguing that all of these things are competitive restrictions that damage the ability of U.S. markets to function. So I want to remind everybody, in the 80s and 90s, the banks were literally saying, if you don't allow us to pay yield on deposit products, they're not competitive, and that's bad for the economy because consumers don't get their fair share and we don't get spending. That is how they got Reg Q repealed. And then the other big argument, largely led by a guy named Sandy Weil, who was the head of Citi at the time, was, hey, I'm competing with all these giant banks globally, but I am dealing with this Glass-Steagall nonsense. We should get rid of that so I could have a global mega bank here in the United States. And so in something called the Gramm-Leach-Bliley Act, they repealed Glass-Steagall. So now from 1933, the only part you've got left is the FDIC, which was the good part, and none of the restrictions. Fast forward to today, when supposedly we're in this ultra-capitalist regime for banking, where banks can do whatever they want, should compete globally, and you now have the bankers deploying the exact arguments they just said were terrible to get Reg Q and Glass-Steagall repealed against crypto to try to protect their own industry because they don't want to compete against somebody else, right? And so it's this very bizarro 180 where the banks have been saying, actually, so we were kidding about all those things we said about deregulation. Actually, why don't you impose a bunch of restrictions on everybody else, but not us, just everybody else, not us, so that we can continue to pay ourselves huge bonuses, right? And the sort of awful part about this is the current framework is excellent for the big banks, terrible for small banks, and even worse for the consumer. And yet they're arguing as though paying Jamie Dimon the biggest bonus humanly possible is a moral imperative for the United States.
Where are we with regards to this argument? And it's truly evolving on a weekly basis. I know that Coinbase has basically put their foot down and said that, going forward, they won't support any legislation that does not include the payment of yield-bearing stablecoins, although there was some wording in there that was more like rewards versus interest. Where do you think this kind of falls into place?
I think it probably falls apart. And I think the reason for that is that the community banks are, what's the right way to say this politely, completely backwards on this issue. So again, let's look at some facts so that we're not arguing from, just imagination world. In 2009, banks outside the top 20 were close to half of the deposits in the system. And in the current day, they're around 20%. So small banks have been getting crushed over a 20-year period. And by the way, that's trillions of dollars of deposits. So anybody who want to tells me stablecoins did that, like, guys, there's 300 billion of stablecoins. The math does not work out. It's not possible, right? This is large banks consuming small banks. And the reason is large banks have budgets for things like technology and new products and deployment, and 12 dudes in Arkansas do not.
Right.
And so the community banks have somehow been convinced, also because they're not spending a ton of money on policy people, by the big banks that stablecoins are their problem and they need to stop them. The great irony is stablecoins probably help community banks and hurt the large banks, right? That is to say, if I am a small bank that can't build my own technology, there might be some appeal to an open access, open standard platform that all of us can plug into to work together, as opposed to having to build the entire proprietary technology stack of Goldman Sachs or Bank of America. They're probably a deposit gathering mechanism. And by the way, you need to start appealing to young customers or you're all going to die off anyways. Yet the community banks are lobbying the hardest against clarity, against stablecoin yield, and against their inclusion, like, in the financial system. And the answer is they've just got the story wrong. Like, I don't know what else to tell you. I've talked to some of the lobbyists. They do not understand the mechanics of how this works. So they are busy shooting themselves in the foot and then reloading and continuing to fire. And the problem is the big banks are not super politically persuasive because nobody likes them, but the community banks are very popular. So if they're wrong way, it's a problem.
Is the argument that there will be deposit flight from these community banks, and as a function of that, I mean, I don't know if that in and of itself is really sufficient to, like, make a credible argument, but the secondary argument is, and then we cannot facilitate local lending, banking in that capacity, which still exists, right? Like for mortgages and farmers or whatever it may be, right? Like they still go to these local banks. So that's sort of where they take it. Is that right? Like we therefore will not be able to do what we've done before. Is that essentially the argument? Because you say the community banks have, in aggregate, more power than these kind of distasteful Wall Street banks.
Yeah, and that has to do with what you just said, which is community banks mainly do Main Street lending. Large banks do not. If you look at the share of balance sheet dedicated to, like, mortgages and small business loans by large banks, it's sub 20%. Community banks, it's a lot of what they do. So that differential is real. Here's the problem with that argument, though. Stablecoins have no change on bank deposits in the system. And I'm not, like, asserting that as hypothetical. That is a factual statement about how deposits are created. Because, like, again, former banker here is how you can destroy deposits in the system. You can take money out of an ATM, which means that you take cash out, deposits go down. That's just a strict reduction. You can repay loans, right? Which is to say both sides of a bank's balance sheet go down. There are certain operations that can occur with the Federal Reserve or the Treasury, which I think we all agree private market stablecoins are not in control of. That's like a Besson type issue. And then finally, banks can sell assets off their own balance sheet. Nowhere in there is like the stablecoin doing it. If you create a stablecoin, I will remind everybody the way it works is a bank deposit goes from the buyer to the seller. It's not destroyed, it just moves. Unless you think when you buy a sandwich, you destroy money, right? The stablecoin's the exact same thing. By the way, the reverse for if you destroy a stablecoin, right? Like you're essentially buying it back from the issuer. And so there's no change in bank deposits. Like it is mechanically not possible. And thus that whole argument falls apart when you're like, well, deposits are leaving these rural banks. I'm like, it has nothing to do with stable coins. The number one growing bank in rural Michigan is SoFi.
Yeah. Okay. So I want to now, this is where I said I was going to maybe probe a bit about this because, and I want to first give some context. I come at this as an individual, and then also what I see the appeal to from certain people, especially in the crypto side, which, as you stated before, oftentimes they don't know what they're talking about. But I'm putting this into context that my perspective is one of me looking at what Coinbase, for example, is selling us on. And I got into this argument recently. I get into this argument a lot in private, but I think you're actually quite a good guest. Finally, the opportunity to ask this, and I really want this again. Like, I want your answer from why should I care, perhaps. So, I was arguing with this guy a formidable opponent, I should say, is like Professor at Wharton or something. And he was talking about all the deposits in the United States that are effectively not earning interest. And my point is that from an individual consumer, the velocity of money is quite high for the individual. And maybe a more concise way to say this is that we Americans live, a lot of us, paycheck to paycheck. I would actually say that probably more Americans than the number suggests live paycheck to paycheck, because even very high earners are spending a lot of what they make, and they may save more like nominally, but in terms of, you live in New York and you make $400,000 a year. A lot of those people at the end of the day are spending $350,000 a year. So my thing about this whole interest with stablecoins is people make it seem like this is a massive unlock. And I'm actually trying to look at the numbers from, say, somebody who makes, let's call it $100,000 a year. Okay. They make, simplify, I don't know, $7,000 a month. That person may spend $4,000 to $5,000 a month. And I'm saying this before, I'm just like leaving out taxes for a second. As a consumer who's supposed to care about the proliferation of stablecoins, if I'm actually thinking about how quickly money comes in and goes out to service debt and bills and loans and whatnot, the actual interest accruing, for example, with stablecoins, maybe not specifically stablecoins, but the competition that stablecoins provide, forcing banks to pay some amount of interest. If you actually look at these numbers, it's like not that compelling to me as an individual, right? So like I was saying, let's say I spend $4,000 to $5,000 a month. Okay, I have maybe $2,000 in savings left. 2.5%, 3% on this. This is not like a massive amount of money. And the point is, like, this isn't accruing. This is why I was talking about like the velocity for the average person. Money comes in and it goes right back out. It doesn't seem from the consumer's perspective to be something that I should really fight for or care about, right? Like an extra 60, 70 bucks a month is not like a groundbreaking innovation for the average American in terms of stablecoin use. So I want to hear, like, and again, my perspective is one of, I see Coinbase fighting for everybody should be able to receive yield on their stablecoins. And I'm like, I personally think like the actual amount seems pretty negligible. Also, my understanding, this is the last point I would make. My understanding, once I dug into this, is that a lot of small, medium-sized businesses actually are already fairly good at sweeping non-working capital. I don't know how you define this, but like, anything outside of sort of working capital into yield-bearing accounts. Maybe that's not true. Maybe stablecoins can improve that, but still, like, I guess the whole like diatribe I've now been on is to point out that this is like a very big deal, and it's a huge point of contention in Congress, in anybody who cares about this. And I'm sitting here, I'm like, it's like it all seems sort of sort of negligible to me. So go ahead.
Yeah. So I'll start by saying I actually don't think consumers are where it matters. Right. I do agree with you on that.
Okay.
Because let's talk some financial products without even getting into crypto, just to make this point, right? Like, I'm going to raise some stuff that exists in the world right now. If you go to Fidelity, you can open a cash management account where the thing backing that account is a government money market fund, and they'll give you a debit card and banking details with it.
Right.
You can earn this interest right now. I'm friends with a woman named Jill Castilla. She's the CEO of Citizens Bank of Edmond. It's a local bank in Oklahoma. They will pay you 2% on your checking account and about 3.55 on your savings account right now through their online bank called Roger.
Oh, that's pretty good.
Like, yeah, no, great product.
That's as competitive as Robinhood, actually.
There you go. If you guys haven't looked at it, Roger Bank. It's military branded, but anybody can use it.
Are you getting paid for that?
No, I get no compensation. Kidding. Right? I'm just raising awareness about products because we should understand how the system works. So for consumers, this is already there. I don't think it's a big deal. I will strongly disagree with you on the sweep products for a lot of merchants, because it is important to start looking at how businesses hold money. If I am a financial affiliated business and I've got good sweep accounts into things like government money market funds for idle capital, that I can probably set up. But that requires you being of a certain size. The people who tend to get hurt the most are truly small businesses, because I guarantee like the local plumber, like your local dentist's office, et cetera, are largely not doing this stuff just because they don't think about it. They're not financial experts. 2, high volume, high turnover businesses get absolutely screwed. And a lot of those are also very low margin businesses. So if you're a grocery store with a 1.5% gross margin, this is life and death for you to get right. And you could basically get nothing. And so when we're looking at where is systemic fairness inside the American system for Americans dealing with Americans to do business in America, the answer is it's really on the merchant and small business side where you're going to get the highest lift here. But I will remind everybody that is a tremendous engine for job creation. So the reason end consumers should care is, do you guys want higher wages? Yes, no, check a box. And keep in mind, it's not like this money goes away if they're not earning it. It just goes into the bonuses of bankers. So if you want to understand like hyper financialization and why we're pushing debt everywhere in endless amounts, it's because the system is currently kind of rigged to favor the lenders and borrowers over the people using the system for payments. Okay, so that's part one. Part two, you spoke about this internal to America. The other big leap here is international to America and America to international. And what I mean by that is all of the money movement is pretty quick inside of the United States. Like at worst, you're using ACH and it takes a couple of days. I dare you to go send a wire, right, to like the Philippines and see.
I did it recently.
Yeah, no,
I sent one to France and it's like went through 8 banks and you have no idea if it gets there until like 3 weeks later. The person who you're paying texts you and says it got here.
and they don't get any interest. All the banks take a fee. Like all of that shit is terrible. And so as soon as you're like an American selling to somebody in Thailand or like paying a vendor in Finland, all of this matters so much more because the correspondent banking system is broken, right? And so again, this is sort of I get why Coinbase is arguing what they're arguing because they're arguing it from a fairness perspective, right? Like if you look at their fundamental argument, here's what they're saying. You put deposits in a bank, they pay you zero, they lend all the money out and take a bunch of risk. And if it goes well, they pay themselves huge bonuses. And if it goes poorly, they hand the bag back to you and hope the government saves you. It's fundamentally kind of unfair. Get it?
No,
but
it is. Yeah.
But for businesses, like if we're talking about where does this drive economics, adding, call it 3.5% on cash margins to small businesses is a huge lift.
Yeah, that makes sense. I think that I also need to like distinguish the fact that I'm very much in agreement, at least ideologically. Like I have no reservations about saying that this is largely a scam that and the incumbents are trying to maintain their position. This isn't lost upon me. I think that, like you said, the point that I've seen pushed, which seems maybe to be the wrong point, but if you want to rile people up on Twitter, you push this point, which is stablecoin yield for, in your base app or whatever. And I'm sitting here, I'm like, have you guys looked at like the actual numbers on this? It's not the most, alluring thing in the world. It's not going to make you fabulously rich, right? And so I think that if there was more of an effort to explain what you just explained, which is like, like the grocery store example is fantastic, right? Like really, really low margin businesses, they're getting wrecked by credit card fees, right? Like 3% on in how they split that, whatever. But like with a grocery store or a gas station or something is like gigantic, right? And it can be make or break. That's like compelling. The earning an extra $40 a month in your base app is like, all right, this is not the selling point I think you think it is, right?
No, and credit card rewards are actually a great example of a thing that's a really fascinating problem, right? Because when you look at interchange, say it's a 3% interchange, a lot of that goes back to the users of the high value cards as cashback, right? Like I'm part of the problem. I have a cashback credit card. I use it all the time because I get cashback. Fine.
Right.
But we should also fundamentally accept that in many ways, credit card rewards are a regressive tax and reallocation from the poor to the rich.
For sure.
Why? Because prices are higher because they've got to deal with the interchange. And mostly the people who have these cards are high credit score people who already have money. So we're essentially charging people who can't get credit more to subsidize rewards for people who can get credit. That is not a great system. And it's fundamental things like that from a fairness perspective should be reorganized. Like I get, again, as the guy who just said I have a rewards card, I get I'm arguing against my own best interests here, but I think the fairness angle is more important.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the Prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer looking to work with a DeFi team that's already proven itself in the market, go to ellipsislabs.com/careers.
Another selling point, or another narrative rather, is this idea that stablecoins will greatly increase net new demand for dollars. And this seems intuitively true, right? Like, especially like on first glance, that seems like, okay, yes, if we allow for, very easy rails and cheap rails and efficient rails, this disintermediates the Western unions and a lot of these fiat currencies in countries that are being devalued at a rapid rate. Yes, there's going to be incentive for people to hold dollars. And we already see this in Argentina and some of these more like second world countries where they do have access to reasonable technological rails, but their currencies may be already sort of undesired. One thing about this, though, is that we have this Eurodollar system in existence. And a lot of the Eurodollar system is sort of comprised of groups, entities in wealthier nations. So I do wonder if stablecoins, like the extent to which you think this will be net new demand for the dollar versus maybe a reorganization of removing a lot of these antiquated Eurodollar rails and those flow into stablecoins instead.
Yeah, so I think the whole net new demand for dollars, we need to be a little bit more specific about what we mean. Back to, my original thing of 90% of the people don't know what they're talking about. So let's talk about potential types of demand for dollars. There's demand for physical dollars. There's demand for dollar deposit accounts outside the United States, and there's demand for dollar deposit accounts inside the United States. Do I think stablecoins are going to do much to the third one of those? Yes, and that's the weird part. And I think it's largely going to come out of the second one. For people who want physical cash, they're going to want physical cash. I don't think stablecoins are a huge substitution effect there unless you have like hilariously large amounts of physical cash. And let's be real, most of those people are criminals. We probably don't want them having the stablecoins. Fine, I get it. The part that's a little different is if you're in the Eurodollar market or want to be in the Eurodollar market, the problem you often have is you're in the Eurodollar market either through your local banking system, which you probably don't like or trust. That's why you're getting into the Eurodollar market in the first place. Like, do you want to leave your money in an Argentine or Venezuelan bank, even if you have a dollar denominated account? Probably not. And then two, can you get one without paying egregious fees or without being incredibly rich? Because if you're in like the Philippines and you want dollars at scale, the answer is, yeah, UBS will do that for you. Also, you need 25 million to even open an account. Okay, great. And so I would tell you, one part of the story is expanding the access of these things to people, not just to get it at all, which is an important story, but also to get it in the US system with US rule of law. Because here's what I'm going to tell you. When the Maduro regime shows up in a US courtroom trying to seize somebody's assets because they hold it in a private wallet in USDC, Circle is going to tell them to go pound sand. Right. And a US court is not going to enforce a political order from Venezuela to seize like the opposition's money. And so it is really not the expansion of just the dollar, but the expansion of US rule of law and dollar norms that is the important part of stablecoins in that transition. And so, like, I've called stablecoins crypto Eurodollars in the past, but what we're really doing is taking money out of the traditional Eurodollar system, putting it back into the direct dollar system globally so that now your quote unquote deposit account with dollars behaves like US deposit accounts as opposed to synthetic Eurodollar accounts for local rule of law.
Yeah, it seems like this is where I probably a lot of this is influenced by how I initially got into crypto, which was through Bitcoin. And I basically did get, one-shotted by the idea of sound money. And I've learned a lot subsequently, but that influences a lot of how I think. And as a result, the idea of extending dollar hegemony, right, for like financial markets, for a lot of what you engage in, that is compelling. It does make things a lot more efficient. There are a lot of antiquated rules and cumbersome systems, but to me, it's like not that exciting, nor is it something I really necessarily want to stand behind. The idea of extending U.S. hegemony through the dollar system, it's not. And to me, it seems like this is how we keep the Ponzi going, really. And it sounds kind of conspiratorial, but it does. Yeah, it doesn't resonate with me, and so I just don't care that much. But I will say, what I think is interesting about mostly what I've heard you talk about is you seem in agreement that a lot of these rails, for example, like the decentralized aspect is reduced maybe in importance when you're talking about Tether and USDC, and then the US government issuing bonds behind those. Yeah, it's like, do the rails really enforce these at the end of the day? So that's maybe a good like pivot, perhaps, is you do have a very sort of pragmatic approach, I would say, in terms of where we find an equilibrium here. But maybe the question I have is, so if you're generally in agreement that Circle and Tether and then, Southern District of New York judge in reality is the ultimate decider, if you will, on, where these stable coins end up or who actually owns this money, then what role does the blockchain play at all in that capacity?
All right.
Well, go ahead.
Let me start with what I think is a misconception that a lot of people in crypto have, and this is where everybody's going to get angry with me, but I'm going to be honest about it. So, one, money. When we say things like sound money, let's get a little bit more specific. Money has three purposes: medium of transaction, store of value, unit of accounts, right? So this means, can I buy things with it? Like, can I buy a sandwich? This means, can I buy things in the future with it, right? That is to say, do I preserve my value through space and time? And the last one is, do I use it to denominate things? I'm going to tell you right now, I think unit of account is far and away the least interesting to discuss, though it is important because we need a base to discuss things, right? Like, everybody should be like, I have 8 horses, I have 2 cars. What are right? You do need a unit of account. I get it, but it's boring. So here's the problem. These two functions, store of value, medium of transacting, exist in inherent tension with each other. And I come down on the Warren Buffett side of things, which is to say sound money does not exist. There is no inactive thing that you can put your money into that will be a good store of value over time. All currency regimes throughout human history get debased, they get messed with, the political incentives are real. You are living in fantasy land if you think the government is not going to try to find ways to expropriate people holding money for their own benefit. Even true of gold. Like, anybody who wants to argue the gold standard for me, go back and look at the history of Rome and currency debasement. It is not sound money. 2, right? Gold has some serious problems. Back to the Great Depression, the issue you have with a fixed money supply like Bitcoin is in a downturn, like a severe downturn, it creates hoarding behavior, which slows the economy down, which makes the downturn worse. This is how we ended up with a third of our banks failing and over 20% unemployment in the 1930s. So you're going to have an internal fight. And the answer I give to people is, stop trying to solve all of the problems with one thing. Bitcoin may be a very good store of value. It's never going to be money in the sense of the transaction bit, right? And if you conflate those two things together and try to do both, you end up in a fist fight with yourself. And so, 1, break those ideas apart as we think about this. 2, decentralization is one aspect of blockchains, but I literally said this in class last night. I think 30 years forward, we're going to look back and say decentralization was overemphasized, and the part that was underemphasized was the open access and composability elements of a blockchain, which is to say, in the current financial system and the way we think of KYC, it's like getting into a private building. You like walk in, you go to the security guard, you show them your ID, they make sure you're on the guest list, and then the little like gate opens and you can go in and go up an elevator. Blockchains are much more like a private park, right? Depending on which blockchain, it's either default is in, and if you behave like a jerk, they can kick you out, or default is in, and quite frankly, nobody can even kick you out, which is more like Bitcoin. That change is far more radical than people understand, right? Like, switching default no to default yes is a dramatic change in how we need to think about information. The last thing that did that was the internet, right? Where like anybody could create an email account and just start using it. And look what that did for global communication. blockchains will do the same thing for money. And to me, that's the far more interesting property, because also when you say decentralization, like back to non-defined terms, I'm going to make a statement that will also make crypto people angry. Ethereum is not decentralized. Your validators all largely believe roughly similar things. The behavior is predictable and understandable in that regard. It's actually got like very severe groupthink in many ways, and it does not have what I would call diversified governance, right? So like Contra, let me propose a hypothetical blockchain. What if we got the 500 largest financial institutions in the world together and all of them were validators on a blockchain and you needed a super majority to change anything? Well, now we've got US, Japan, China, Europe, all having to like agree on something to make a change. That might be more credibly neutral than Ethereum.
Yeah. I mean, I think that's fair. I also, yeah, I mean, like Swift is pretty decentralized. In fact, obviously they can cut off Russia, but like for all intents and purposes, like most transactions flow pretty seamlessly through. So yeah, but I guess then what was coming back to this debate you had, I heard with, is it Omid?
Yeah.
Yeah.
So here's a funny part. He will himself answer to both Omid and Omid. So you kind of can't get it wrong.
Okay, perfect. Omid, I didn't know that you guys had like worked together prior. So this debate was more of like friendly fire, I suppose, than anything, too contentious. But you guys took pretty opposing sides. So just like maybe give me a rundown of that, because I have some questions on that.
Yeah, so I think if I'm trying to steelman Eid's like viewpoint here, I don't want to speak for him. You guys should go listen to the debate. But to try to summarize his view, he is saying that most centralized financial institutions trend towards corruption and expropriation and are fundamentally untrustworthy. Therefore, decentralized, self-custodial, non-intermediated systems over time will win. And my counterpoint to that is, one, that's not how the world works, because even if you believe that theoretically, good luck getting that to actually happen with your hands, right? Like, that is a very Otto von Bismarck, politics is the art of the possible type statement. But two, the reality is most people to exist in a truly decentralized self-custodial world do not have the time or expertise, and the system collapses upon itself. Like I wrote an article a while back called Techno-Barbarism that basically says, due to the nature of specialization of labor, the best actors in that space will be the ones who spend the most time on it, and the ones who spend the most time on it, hilariously, will be the pirates. So what this ultimately does is creates a system of like maximum theft. Essentially, you think you're arguing for blockchain utopia, but what you're arguing for is blockchain Mad Max. And it creates this sort of perverse incentive structure where the North Koreans end up being the long-term winner if you have a truly permissionless decentralized system. And that's why we have intermediation and rule of law, like transaction reversal. And so my point, as you've thought about this problem, is that the goal is not to end up either at the extreme of centralized intermediaries control everything, or the extreme of everything is like genuinely decentralized and permissionless, but rather to use those competing forces to strike a balance in the middle where we create the system that understands sort of both of these concerns and attempts to find a balance point. I will also make a point that I believe it is important that things like Bitcoin that are permissionless exist because they serve as a policing function. And what I mean by that is, yeah, if your system is worse than Bitcoin and people can opt into Bitcoin, Bitcoin becomes the floor.
Right. And also the fact that you can take custody, like I think it's been obviously this has been a bit jarring to a number of like early Bitcoiners, and I probably shifted my own perspective on this a bit with regards to self-custody. I was at a wedding like not too long ago, and some, rando asked me how I would buy Bitcoin. And I said, like, look, buy IBIT. There's no point in trying to take custody. I think the risks are higher, given that you don't know anything about this, just buy IBIT. I tell my sister the same thing. My point though is that it is a good check. And I think it is a very, very, it's maybe the strongest check we've ever had in the ability to take self-custody. And in theory, we can audit the validity of IBIT. If we have money on Coinbase, if we can't withdraw it, we are in some capacity auditing that system. And I don't know if we've ever had as good of a way to police, as you say, or a check on, the ability for custodians to do what they do, which I do tend to agree it's expropriate or steal or whatever it may be. So I am still optimistic about that notion. And I think Bitcoin, obviously, for me, is the one that is very compelling. And I also do think that generally like you said, this kind of like, if you have Bitcoin here and then any subsequent system, like the fact you can opt into Bitcoin, that seems like sufficient. I even think about this with regards to, more technical aspects like layer 2s, like a lot of the ability to exit. It's actually, like an escape hatch, it ends up being not efficient and as costly as a layer 1 transaction, but it does disincentivize theft, right? So the fact that you can always watch for theft or nefarious activity with a Lightning node or even an Ethereum L1 node that can verify the state an L2 and withdraw. No, it's not very cost effective. And yes, like you end up sort of indifferent, like both sides end up indifferent from like a game theory perspective, but we've never really had that ability to, have such a strong check. So I am optimistic about that. But I guess the thing that I wonder then is, so we agree that maybe like you have the ability to opt into Bitcoin, and then any subsequent system could be like perhaps slightly more custodial or have some trade-offs. But where do we kind of fall in the end game? Because then it seems to me that you talk about this idea of composability. Like, I don't even really know what that means anymore. Like, I know what you're saying, and I know what like Tolly's, for example, from Solana's view on composability is. But we used to think of composability as really like atomicity. That was a better way to say it. And it was all that everything existed on a unified layer and that you could move in and out. And now between L2s and then custodians and this stuff, it really starts to become it. To me, it gets to the point where like everything is basically composable with everything. We had a lot of inefficiencies before. And so now I'm just wondering, like, is Robinhood L2, like, do we consider this composable, right? Like, because that's a little bit of a different definition of composability than maybe, like atomic transactions that we thought of in the past.
On the composability point, I think, this is back to crypto not understanding some of the lessons of TradFi. You have a lot of people with this idea that, if we create our own thing because we have users, people will use it and therefore we'll accrue all the value. That is not how network effects work in finance. Like, let me just say this for everybody. If you're a tech person and you've thought about network effects on the internet and you superimpose that framework onto finance, you are overwhelmingly likely to incinerate a huge amount of money doing stupid shit.
All of the VCs have for the past 10 years. They apply Metcalfe's law when they don't realize that the network effects of Facebook are not like the network effects of Ethereum. It's vastly different, but it is like one of the most misunderstood concepts by some order of magnitude, really. And it has incinerated a lot of money.
Yes. I mean, I was at JP Morgan. We had a thing called Onyx. And I want to remind everybody, JP Morgan is probably the largest financial institution in the world. It's got a balance sheet of, $4 trillion at this point. And they couldn't force people to use their blockchain. And you guys think Stripe is going to do that? Like, what are you smoking? Okay. But point is, composability is going to be defined as, can you get things easily in and out of a system and combine things within the system? Like, the analogy I use for it is actually containerization of shipping, right? Yeah. Which is to say, can I have a standard container that I take off one ship, load onto another ship? We can stack them all the same way. We can move them around all the same way. It's very efficient, very quick, very painless, especially if you automate your ports. Looking at you, Los Angeles. But in general, think containerization when you think about composability. And the whole point is, can I use a trading system here and then move the thing over here and use the borrow lend protocol over here and then take that money and move it over here and pay for something, right? And do that all seamlessly. That is a composable system. And to something like Robinhood's L2, the answer is, I have doubts. Because when it's a single company, they have all of these incentives to impose checkpoints, gates, fees. Like, this is inevitably what people are doing there. And why I think many of the private blockchain efforts are essentially a bridge to nowhere, right? You're just rebuilding the exact same problems you had in TradFi, only you're using a slightly different ledger. And let me tell you right now, if your blockchain is not distributed in terms of validation for some definition of distribution, it's just a database, right? Like, if one guy controls all the validators, that is a database, right? It's a database with extra window dressing, but it's a database. So the composability point, I think, applies to things like Ethereum. I think it applies to Solana. I think it applies to some of the more interesting blockchain designs. Like look at, good examples here, Stellar or Avalanche, which are things I know the crypto people hate, but actually have some very interesting core financial thinking in there. I don't think it's going to age well for things like Tempo or Onyx or like what Robinhood is doing.
Well, this sounds a bit like you're maybe, at least in this capacity, you're kind of in agreement with Omid.
I mean, again, this goes back to being pragmatic. Let's take the endpoints. One endpoint, complete decentralization to the point that no coordination is possible and no permissioning is possible. Let's take Bitcoin on that extreme. Okay. The other extreme is Onyx, where 100% of the control goes to JP Morgan. And I am saying that the system where most assets will transact in the long run is not going to be the ideological extremes. It will be something in the middle, because you are going to need the ability to respond effectively to something like the ByBit hack. But on the other hand, that needs to be some sort of, call it societal level consensus response. It can't just be like JP Morgan doesn't like that you said something mean about them in the press, so now they take away your banking access, right? You can live between these endpoints and extremes. And so like a great example, Stellar, let's go back to them. They have a set of tier 1 validators on there that all essentially work with each other on the network. And if you look, it's people like the Franklin Templetons of the world and real world asset issuers who can blacklist, freeze, and seize at the validator level if they do things in the right way. And let's go back to my example of if you had 500 financial institutions, you know what's going to happen there? If it's some individual country being dickheads politically to somebody, the other people are not going to vote to freeze it. But if the North Koreans hack the whole network, all of them have an incentive to freeze it. And so it becomes a question of what sort of like activity do we interdict versus not to make this usable for the average person? Because to go all the way back to your original point on self-custody, great example of this, my mother. My mother was a nurse. She ran UCSD's bone marrow transplant clinic and worked very hard. You cannot tell my mother for any moral framework of the world, hey, listen, fuck them kids with cancer. You need to work less so that you understand the permissionless future of money and can protect yourself from the North Koreans on chain. That's insane.
Yeah. Well, you mentioned the ByBit hack though. Was the insinuation there that Ethereum, I don't want to put words in your mouth, but like, are you implying that in the future, people won't want to have money on a system whereby North Korea hacks a tremendous amount of money and then Ethereum's validators do nothing, which, I mean, it turned out okay, right? Like, I don't know. I don't know. Like, do you think that was like a real, I think that it would be I think it would have been bad for North Korea for Ethereum validators to fork out North Korea. But go ahead. Now I want to hear why you brought that up. Maybe.
My counterpoint is if you want to use that to trade tokenized real assets, I think it was catastrophic, right? Like I talked to US banking regulators, I talked to the SEC, I talked to the CFTC, I talked to the folks at the Department of War, right, who are thinking about this. 99% don't think Ethereum is a suitable platform. Right, because they're looking at this and saying, hold on, so the base layer token that gives you governance rights can be stolen in unlimited amounts by the North Koreans. And we think that's a good system.
Yeah, right? But this doesn't, okay, so but my thing is this, what bearing does this have on tokenized Tesla? Like Tesla will just delete them out of the database if North Korea hacks a bunch of Tesla shares.
Okay.
Tesla can say no, like that you don't own that, right? But with ETH, I understand. I'm sympathetic with ETH, but I don't know that it matters that much. Like, who cares if the ETH is stolen? It's down only.
Well, yeah, okay. The price they have, the North Koreans may have lost themselves a lot of money. Guys, steal something smarter. No, so there's two problems to that. One, there is cumulative governance decay because of this. Like, yeah, they stole it this time, but imagine 50 more of those happen over the next 50 years. At some point, the North Koreans have a shocking amount of control of the network because of how many tokens they own, and it starts becoming a real problem. Yeah. So one, cumulative governance problem. That is real. Two, okay. So this is the point that I was making earlier about how systems work. This time it was ETH that got hacked and the network didn't interdict it. You just said, hey, Tesla, let's say they issue tokenized stock. That's got its own smart contract. The North Koreans steal stock. They just freeze it. Cool story. What if it was the smart contract for Tesla that is the thing that got hacked?
Why does that matter?
Okay.
What do you mean?
Let's say the North Koreans get their hands on the keys to control the smart contract for Tesla stock. Now what? Right.
We just delete it again. Why does it?
Cool. Okay. This is where I thought you'd go. We'll deprecate the contract and we'll just create a new one and start over. Right. So now,
or bail on crypto. Like Tesla can just be like, all right, we tried.
yeah, which is, let's assume we're trying to have blockchains work. Okay. So bail on crypto is not ideal here. Let's be clear about that. The whole, hey, we'll deprecate this whole token and just launch a new one to replace it works fine for the token. But somebody, please, for the love of God, go check on like Uniswap and Aave and like any decentralized protocol in this context. If you do not have a network level control where you freeze everything until like the pop and drop is complete, you're just going to wipe out every goddamn DeFi protocol as soon as that happens.
You mean with regards to people using Tesla shares in these protocols?
Yes. Right. So then your other option is, okay, so we don't let real world assets into any sort of decentralized financial application. And then I come back to, okay, so we want our blockchains to essentially be send only like custodial things. And don't get me wrong, that has some value, but that greatly limits what you can do with them. And so the point I'm making here, right, which is again, back to core financial risk management, all systems that stand the test of time have multiple redundancy, and crypto loves to build things with a single point of failure. And it is a matter of time until that breaks catastrophically.
Yeah, that's true. I guess, look, I'm on your side. Like, I'm ironically, for whatever reason, arguing the other side. But I guess that I think it's feasible for Tesla to, or like with this Robinhood L2, like I would be very, we don't know what it's going to look like, but I would be very surprised if the shares that are traded there, if Uniswap can launch that. I think I heard a podcast recently where they were saying we're inviting like old new applications, whatever. So I'm going to assume, like you said, that those are of the some of the decentralized variety, AMM, for example. Yeah, I would assume that they have something in mind as to what happens if that AMM gets hacked on there. And I do see your point with like the single point of failure, but I think a lot of people over index on code being law, especially with regards to RWAs, like it's clearly not. But then it seems like the fixes are annoying, but possible. But that makes me surprised to hear that you say that, for example, you talk to a lot of big banks and they look at the ByBit hack of ETH as being, pretty damning with regards to their like long-term, wanting to put assets on there.
So part of what you've got to remember though is who like holds the bag on that stuff. If you're the custodian and the ETH gets stolen, you owe that money back to the consumers in a US framework.
Right.
So Boney Mellon, to name a bank that's a big custodian in the United States, losing 1.4 billion of ETH, owes 1.4 billion to their customers. And by the way, they're charging basis points on custody. So they will rationally look at that system and just be like, nope, right? Like they're not even going to do it. And this is my point of it. If you can't get network level controls in there, the economics break down very quickly, because here's the truth of self-custody. A lot of things get lost, stolen, or hacked, right? The attrition in self-custody is large, and commercial enterprises will price that. Like, how do you feel about paying your custodian 5% per year just to hold your assets? If you don't like that, you kind of agree with me on the points I'm making just from an economic standpoint before we get to anything else. And when you're the person who actually is the bag holder in this, you look at these systems and go, absolutely fucking not.
So then, okay, I know now I'm going to press you more on like, where does the equilibrium fall? Like you're saying that if it's way too decentralized and there's no sort of fallback recourse, there's just these single points of failure. You point out ByBit hack. This is untenable for large financial institutions. And I definitely understand with regards to ETH, that is very catastrophic, right? Like the base asset, if it can't be, clawed back. Then on the other side, you say that, you don't view the future being these single validators or even of, small consortium of sort of very aligned, 5 or 6 people, whatever it may be. So it like falls somewhere in the middle. What does that look like in practice?
So one, we're going to try a bunch of dumb stuff before we get here. So please don't over predict that I'm saying this will happen right now. Like the nature of markets is we're going to tinker and screw around and break a bunch of stuff. But in the long run, what will work? there's two analogs that look good historically in this space. One is something like DTCC, which is you got all of the major institutions in on day one, and they have a balanced say in governance. So again, if somebody actually launched a blockchain that had, like, let's just focus on the US for a moment, all of the big asset managers, payments companies, banks, and insurance companies, I would be like, you know what, that thing's probably going to win. Right. But that means you probably got 20-ish banks, at least 10 asset managers, Prudential, MetLife, et cetera, all the big like life insurance companies in there, and Visa, MasterCard, PayPal. That's a big consortium of people who do not have identical interests. And that makes it very hard to start expropriating people with group governance, because you're not going to get them to agree on anything unless it's catastrophic to all of their interests. That sort of balanced consortium approach probably works. They're just slow. And usually they happen after some sort of crisis occurs. Two, if you're looking at something that could grow organically, a really good model for people to look at, excuse me, from crypto is Visa, right? And I will remind everybody that started in Bank of America. They realized it didn't work if Bank of America controls it. They spit it out, and it has to create a genuinely neutral, externally enforceable set of rules that they are bound by to get everybody to adopt it. So where should the balance point be in these things? One, governance that's going to give a broad variety of people with differential viewpoints a stake in the governance. And that's where some of the blockchains fail, is you actually have too much ideological conformity right now. Like, you need more cranky people like me in governance to really make this balanced, along with the current people. That's not exclusionary in either direction. Two, you're going to need a wide enough remit that's binding. And the balance point should probably be this: individual judgments should be ignored. Like, I don't care if JP Morgan is angry with you. I don't care if Bank of America is angry with you. But two things should be possible. One is that large-scale community judgments for that diversified group can be enforced, e.g. everybody says the North Koreans are not cool, we can take the money back, right, and freeze it quickly. Two, and this is, again, realpolitik, you need to be able to respond to court orders, right? Because if, to go back to our example, you tokenize housing title and a house title gets stolen, no judge in the Southern District of New York is going to be like, well, I don't know, man, some anonymous random validators say North Korea owns your house now, so I guess that's how it works. And to be clear to everybody here, code is not law. If the courts and the blockchain disagree, the blockchain is wrong, right? So if you want this to be a useful ledger, you have to be responsive to those.
Why do you say that something like Tempo you don't think will work, though? Like, go ahead.
Pitch me on using Tempo as PayPal or Block or Visa or MasterCard.
I mean, what's wrong with that?
Why would I send economic gains from my customers and business activity to one of my biggest competitors?
But I think that Stripe is, well, okay. Then this sort of, but okay. So I don't maybe disagree, but then the logical conclusion of this is just I don't see how they, like, for example, I don't see how in that case they're okay with Solana validators taking, 20 bips or whatever when they're the user facing application or whatever. So like, I think you can extend this beyond, if that's the claim. But I see what you're saying, but the reason I asked, so
hold on, let me pause you on Solana, because this is an important point. What you'll find with these things is that competition by neutral parties who are not like your direct competitor in all ways can work. So Solana being like, we're just here to be a transmission layer. We're happy to trade stocks, bonds, like stablecoins, gold, all of it. And by the way, we're not going to do like all the KYC, AML compliance, travel rule parts of payment processing. So Visa, if you use us, you can still charge a fee. That's possible.
Okay.
Tempo, I think, particularly because it is a competitor doing all of that other stuff as well. It's the Bank of America problem with credit cards. If you want JPM to issue a credit card, they're not doing it on Bank of America's network.
Okay. Yeah. So I guess that maybe I was thinking that Tempo sounded like a sufficiently differing interest consortium, but maybe not. Whereas Solana, conversely, could be because, right, the validators do, are competitive, but can be like there can be some equilibrium there.
Yeah. And by the way, this is not a knock on like Tempo's utility or technology. This is purely a statement about governance of like, I don't think you can convince the other payments companies to use it while one of them has such a controlling stake. Again, why Visa was spun out became like the current model is that doesn't work. People won't join. If you want to do that, you're building American Express.
Yeah. Okay, well then that kind of leads us to our last point, just with regards to where you see tokenization in general playing out. I mean, I guess that the irony with all this stuff is that, like what we were just saying, and I'm very much in agreement. I would even take it a step further and say, like, well, maybe this isn't a step further, but it's just a different way to say this. Like, I don't think you can self-custody a stock or self-custody a house. Like, just at my understanding of what self-custody means, you can't. Right now, you can have a token in your wallet that may have slightly more difficult time. Like, for example, with stablecoins, we see this now. They are like, one thing I have come to agree with is like stablecoins are harder to repossess than dollars in a bank account. Right. So like it is more difficult to go to Tether and get them to scratch your name out of their database than it is to go to, the US government just going, getting a search warrant or whatever, easy like thing that they can do. With regards to tokenization, though, this is even like more apparent. You bring up the house analogy. Obviously, I agree with this. You can't truly self-custody a house. What's the value proposition there then in the blockchain aspect? Like, to me, it becomes very, very difficult to discern.
This is where I think the people who are likely to create the biggest change in this system probably come from the guts of the current system doing relatively institutional stuff. Because let me point out some major use cases for blockchain. One, the inability to self-custody something where your definition of self-custody is 100% absolute self-control. I agree with you on any permissioned asset, right? Like, even if you put your stable coins in a private wallet, when I was at Paxos, I could take them from you. Like, you should be aware of that. But that doesn't mean I want to leave my stable coins with Silicon Valley Bank, right? The ability to put them in a non-intermediated wallet still has significant value. Like, I may not be solving 100% of the problem, but I can solve 80% of the problem, and that's still a pretty big upgrade in many cases. So that serves as a policing function for the behavior of all of these entities. Two, there are a lot of, I'm going to call it containerization and interoperability problems that exist within the current system that these things do solve that are very big. And just because they're retail facing doesn't mean they're not there. A really good example, and this is completely inaccessible to retail people or even solving it, is global interest rate derivatives clearing, right? So the problem is we have all of these sort of like clearing houses that we built post-crisis, but I've got like one in Europe and one in the US and one in Japan. And if I'm back on the desk at JP Morgan and I trade a swap in the morning with Europe, and then I trade a swap in the evening with Japan, I may be flat risk. So like I'm long on one and short on the other, and I'm posting margin on both fucking sides. And that is super annoying. And that is purely a fragmentation problem. If we could get to 24/7 global clearing and margining, we have a system with less risk and we unlock about $1.4 trillion of collateral. That's a big upgrade, like very big. So those things will inevitably happen. The gravitational pull is too strong. The third one is that the transparency element of blockchains really matters, because what would not have been possible with a blockchain? Bernie Madoff. Right? If you're running an actual literal Ponzi scheme where somebody gave you money and they want to see the investments, you cannot do that on a blockchain if they can view your investments, right? And so there are many forms of tracking and understanding the current system that allow for policing of bad conduct. Like, we also would have known that AIG sold 50% of the fucking CDS in the whole world prior to 2008 if we had had a blockchain. So again, it comes back to, I'm not so sure the decentralization matters as much as like the open access and composability parts in the long run.
Yeah. I guess I just wonder, like, there's this idea of like privacy for the individual and transparency for whatever the saying is. But yeah, like, I guess to your point of Bernie Madoff, like that's like right there in the gray area for me, where not what he did, but it's like, it's in the gray area in terms of, like, should hedge funds or money managers or family offices should their investments be transparent in that capacity? And then like, where do we kind of draw the line? That is because,
well, let me also say this. on what time frame and in what ways and to whom. Like that is
Right.
not a binary statement. I'm not saying everybody in the world needs to see Bernie, but if, let's take an example here, if the SEC could have just checked occasionally, like, hey, is the money there? And the answer was yes. Or the answer is no. Like that would be nice to know. I'm not like an anti-privacy person. I actually believe very strongly in it. But if you believe in privacy is never discoverable and fully anonymous, that I disagree with, because that system actually is maximum abuse.
Yeah, I agree with that. Okay, well, this has been fantastic. I really appreciate it. Thanks for taking the time. I thought we got to hit on a bunch of different stuff, so I think listeners will enjoy.
I hope so.